computer. So we're now going over the quiz for Chapter 8. All of the following are potential risks of replacement of an individual health or disability insurance policy, except, and remember, this is health insurance basics, but for the most part, many of the things are going to be the same as life insurance. So if you learn the life insurance side, the health should be easy. And as I said before, if your state doesn't require you to take the health exam, then don't. So all of the following are potential risks of replacement of an individual health or disability insurance policy, except coverage due to an accident will be restricted for 30 days after the effective date of the policy. Premiums may be higher than the original policy. We know that's true. If they're older, it'll probably be higher. A new probationary period may go into effect, limiting coverage for losses due to sickness. That sounds true. Coverage may be reduced or excluded due to a pre-existing condition. That is almost certainly true. So these three, B, C, and D, are probably true. So now let's go back to A. Coverage due to an accident will be restricted for 30 days after the effective date of a policy. I do not believe that's true. Either of you guys agree?
Yeah, that's not true.
Yeah, correct. Replacement of a policy may result in higher premiums, exclusions due to pre-existing conditions, or a probationary period limiting when losses due to a sickness are covered. Losses due to an accident are not affected by pre-existing conditions or probationary periods. Oh, wait, what just happened? That's weird. I have no idea what just happened. Okay. When a policy is mailed to an agent by an insurer after being accepted as applied for an initial premium paid, it is considered to be issued, legally delivered, rated. We know that rated has nothing to do with when is accepted as applied for. So accepted as applied for, rated actually means that they changed the rating and they decided to charge them more, or purchased. Purchase doesn't make any sense. The issue date, it's either issued or legally delivered. So now let's read it again. When a policy is mailed to an agent by an insurer after being accepted as applied for and the initial premium paid, it is considered to be, I believe the answer is issued. Delivered is not until the customer receives it. So I'm fairly certain it's issued. Delivered. Oh, wow. So as soon as it's mailed, it's considered delivered. Okay. So when a policy is mailed to an agent by an insurer after being accepted as applied for the initial premium paid, it is considered to be a policy is legally delivered. A policy may be delivered by registered or certified mail with a signed receipt of delivery. Constructive delivery occurs when the insurer places the policy with the delivery service and no longer has physical custody of the policy. An application for health insurance was submitted on November 1st with the initial premium and a conditional receipt was provided. Due to an existing medical condition, the underwriter requested an attending physician statement, medical exam, and MIP report. After reviewing all sources of insurability, the insurer issued the policy as substandard with a surcharge. A policy was delivered by the producer on December 1st. After explaining the coverage and surcharge, obtaining a statement of good health, and collecting the premium, coverage became effective as of the date the medical exam was completed and underwriting reports were received. Policy was mailed to the agent for legal delivery. Agent explained the policy coverage, surcharge, and collected the additional premium. Application initial premium were submitted and conditional receipt was provided. So in this, they're talking about a substandard rating with a surcharge. So that means that the person has to pay more. So which do you guys think it is? Do you have a sense?
I would say C.
Yeah, that's my guess as well. Although the initial premium was paid and a conditional receipt was provided, the policy was not issued as applied for. Therefore, coverage is not effective until the insured accepts the counter offer and pays the additional premium. If a premium was not submitted with the application, the producer must deliver the policy, explain the benefits, and collect the premium. The issued policy is the offer, and the premium becomes the what's the opposite of offer? Do you guys remember? Without even reading these. Offer and if I offer you something, what do you usually do?
Accept it.
There we go.
Fine.
So without even reading this other stuff, let's not be confused and just know that there's always an offer and then an acceptance. The policy is the offer from the insurer to the individual who accepts the policy by paying the premium. So offer here, would you like insurance? This is what we can give you. The individual accepts it by paying the premium. The prior medical conditions for which the policy has received or should have received medical advice or treatment within a specified period before the effective date of a policy are called the prior medical conditions for which the application has received or should have received medical advice or treatment within a specified period before the effective date of a policy are called probationary conditions, pre-existing conditions, elimination period exclusions, excluded conditions. Within a specified period. This is one of those questions where they're just trying to confuse the wording. Do you remember this one, Daoud?
No.
What did you say?
No, I don't remember this one.
Medical advice or treatment within a specified period before the effective date of a policy are called. Okay, this has to be pre-existing conditions, I think.
It's the only one I find familiar.
Yeah, elimination period exclusions, never heard of that. Excluded conditions, maybe. The prior medical conditions which the applicant has received or should have received medical advice or treatment within a specified period before the effective date. See, no, there shouldn't be excluded. Yeah, they're pre-existing, almost certainly. Yeah, pre-existing conditions are those that are recognizable existing before a policy is in effect. So all this jumble of words is just saying that if they have a prior medical condition, it's called a pre-existing condition. Ignore all those other words. If the premium is paid at the time of application, the agent will provide the applicant with a conditional receipt, claim form, free look notice, or statement of good health. Guess this one, Rashad. I think the words were listed elsewhere in another question. Do you remember?
If the premium is paid, is it conditional?
There it is. Exactly. Conditional receipt. You see, when you read the questions and you read the wording with a little bit of familiarity, they'll start to become not necessarily obvious, but some of the questions will become logical. Some of them. The agent will provide a conditional receipt if the premium is paid by the applicant at the time of application. One thing I want to say, always issue a conditional receipt. And the way we do that on an electronic application is we put their bank information and then we say that we've given a conditional receipt. That's how normally in the olden days we would have to have a physical check in hand. Now we can just put their bank information. It's the equivalent. In the event of a policy is delivered by an agent to the insured and the premium payment is to be collected at the time of this delivery, normally what else must the agent obtain to make the delivery complete? A statement of good health, an affidavit from the applicant, additional payment reflecting lost interest, postage and handling fees. They also mentioned this in a previous question. Any of those words sound familiar to either of you? So it's a statement of good health. Yeah. So in other words, if they didn't pay at the beginning and then they pay, they've got to get a statement of good health. And the logic behind this is, okay, I'm going to go apply for life insurance. And then I get approved, but I haven't paid yet. If their health has changed, they have to give a statement that they have to give a statement basically that their health has changed. And that's what a statement of good health is. The insurer's underwriter may find information about an applicant's moral character, hobbies, work, and general reputation from a medical examination. No, you won't find out about hobbies in a medical examination. Attending physician statement. No, your physician is not likely to know your hobbies. Consumer investigative report. Okay, that's possible. Agent's report.
I'm going to go with agent's report.
I'm going to go with agent's reports too. But I also thought that it could be, actually, consumer investigative report was what I first thought. But then I thought, okay. Let's reread this. The insurer's underwriter may find information about an applicant's moral character, hobbies, work, and general reputation from a consumer's investigative report. So let's imagine a moral character. Let's say that there's I don't really want to call this moral character, but let's just, something they might find is the person's had bankruptcy. So that shows that, they might have some issues managing the money, and that would show up in a consumer report. Bankruptcy, that's where they're going to look for it. So
they're looking for like bankruptcy, white collar crimes, make sure you're not money laundering and stuff like that.
Exactly. Exactly. A producer gathers information about the applicant for the insurer in order to avoid adverse selection. This is considered to be application process, principle of indemnity, field underwriting, law of large numbers. So the producer gathers information. That's the key phrase. So field underwriting, that is what I believe it is too. The agent's primary underwriting role is to make sure the application provides proper information for the insurer.
Do you have to have a license to do underwriting?
I don't know what requirements they have. They, I'm sure, have their own whole world of requirements, and it probably includes a license plus a lot more. Right. But I've never looked into being an underwriter, so I'm not sure. If an application is submitted with a question left unanswered, which of the following should occur? The insurer would require an answer when a claim occurred. The insurer would waive the question. We know that's not true. The insurer would deny the application. That's unlikely. The insurer would require an answer before issuing a policy.
Yeah, that sounds about right.
That sounds right. They're probably going to say, okay, give us the answer to this. Why did you check it? Miss it? Yes. Any unanswered questions need to be answered before the policy is issued. Which of the following has primary responsibility for ensuring that the application is filled out completely? The insurer, the producer, the home office underwriter, or the actuary? The primary responsibility.
Insurer.
It's either the insurer or the producer.
The producer can have the opportunity to mess up, but the insurer better not submit it and let it go through with anything missing, right? So wouldn't that be primary?
Yes, I agree. It's just we'll go with that. I understand your logic. We'll go with that. So it was the producer. So it is the agent producer's responsibility to make certain the application is filled out completely, correctly, and to the best of his or her knowledge. So so we have to remember primary first, most important. It's our job to try to do everything we can to get the application right. Think of it this way. If we don't do it correctly, it's going to slow down the process. So they're sort of the insurers, the stopgap to make sure that it's done right. Which of the following is not considered an underwriting factor when determining insurability for health insurance? Not considered an underwriting factor. Medical background, of course, that's important. Spouse's education, why do they need to know that? Hazardous hobbies, absolutely. Type of policy being applied for, absolutely. So the only one that doesn't make sense, their occupation might matter, but the spouses shouldn't matter at all.
Mm-hmm.
The insurance applicant's occupation is an underwriting factor, not the spouse's occupation. A medical condition that was treated prior to the effective date of a policy is a surgical condition, prescribed condition, probationary condition, or pre-existing condition. It's interesting. They have two questions about the same thing in one quiz, which they oftentimes will do. So do you guys remember what this one is?
Pre-existing.
Yep. A pre-existing condition is one in which medical treatment was obtained or should have been obtained by the applicant prior to the effective date of the policy. A premium is paid at the time of application and a conditional receipt is issued. If the policy is issued as applied for and assuming a medical exam has already been completed, coverage becomes effective at the time the policy is issued. If the policy is issued as applied for and assuming a medical exam has already been completed, coverage becomes effective at the time the policy is issued, at the date of application, after the free look expires, upon policy delivery. Coverage becomes effective. It should be at the point in which it's issued. Issued is the same as effective. I am fairly certain on that. Oh my, of course. This is, okay, see, this is why I like this strategy of study. Because, so a premium paid at the time of an application, a conditional receipt is issued. If the policy is issued as applied for and assuming a medical exam has already been completed, coverage becomes effective at the date of application. So now let's think of this in real world terms. You apply on January 1st. It goes through all of the underwriting process. They do the medical exam on January 5th. January 6th, the person dies. They continue with the underwriting. They've already paid conditional receipt. Because the time of application, the date of application was January 1st and the medical exam was done on January 5th, they die on January 6th, they will pay the claim if it's issued as applied for. So that means that at the date of application is when the policy goes into effect. The conditional receipt is issued upon the premium being paid at the time of application. If the policy is issued as applied for, coverage is effective as of either the date of application or the date of completion of any required medical exam, whichever is later. Since the question asks you to assume the medical exam is already complete, the date of application would be the later date. Does that make sense?
So
So,
apply for.
Go ahead. Go ahead, Rashad. What was your question?
yeah, the same. I think it was kind of the same question. So a premium is paid at the time of application or conditional receipt, assuming the medical exam has already been completed. I think that's where I got confused. It said,
That is a little
and then at the
confusing.
bottom,
How could they have a medical exam done before the time of the application? That's one of those if then questions that is almost never going to happen. So it is really weird. This was a trick question.
Yeah, that's what I was gonna ask. Like the way they phrased it was really messed up.
Yes. So they're trying to trick us here, but understand that the key here is, since it's coverage is effective as of either the date of application or the date of completion of any required medical exam, whichever is later. So whichever one happened after the other. This won't happen like this, but just understand the order. Application, medical exam. If payment is made, then it becomes effective as of the date of whichever happened later. So what normally happens is the medical exam happens afterwards. So that would be the effective date.
and with the application, with the medical exam, would that change based on the type of policy they're getting?
Yes. Not everyone even requires a medical exam. For example, if they look at your medical history, what's called the MIB, the Medical Information Bureau, and they look and see that your doctor says you're healthy, they check and see that there's no medications that you're on, there's up to a certain amount that they don't even have to do a medical exam. They'll just say, okay, approved. Children are oftentimes approved without any medical exams. Any other questions here?
No.
Okay. If questions are incomplete on an application and the insurer issues the policy, a claim is covered only after the first 2 years, not covered if discovered during the incontestability period, covered since the insurer issued the contract based on an incomplete application, not covered and the policy is canceled due to fraud. This one is a logic question. What do you guys think the answer is? So if it's the insurer, if the questions are incomplete on an application and the insurer issues the policy, if it is the insurer's fault, then they are covered since the insurer issued the contract based on an incomplete application. The insurer has to take all of the responsibility if they made any mistakes. If a policy is issued with questions unanswered, the contract will be interpreted as if the question had not been asked and is therefore waived by the insurer and covered. Any questions with that one?
No,
But
no.
if the insurer issued it incomplete, does somebody go back and discover that it was incomplete, or they just let it go?
They might have let it go. It could have been an error. It could have been, who knows why? Or they might have just decided that the question wasn't necessary. I mean, I don't know in what real world situation this would happen, but what they're just trying to express is if the insurer makes a mistake, they've got to swallow it.
Got you. Okay.
That's the real point that they're trying to make here. And they usually use this example in terms of whether the application is incomplete or not. That's usually where they try to, this is how they illustrate this point. Okay?
Mm-hmm.
Okay. The blank was created in order to alert insurer home office underwriters of errors, omissions, or misrepresentations made on insurance applications. Consumer investigative report, the agent's report, MIB, attending physician statement. Home office underwriters of errors, omissions, or misrepresentations made on insurance applications. So a misrepresentation is most likely going to be in terms of health. So remember, the consumer investigative report looked at things like
hobbies,
moral, work, etc. I think, what are you going to say?
I said, I think it would be the MIB.
I think it's the MIB too, Medical Information Bureau, because that's what's most likely. Oh, I just forgot that I'm on 100 medications. Oh, I forgot that I have cancer. Like, that's not going to come from the consumer investigative report. That
Right.
would come from the MIB. So I agree with you. I think that's the answer. So the MIB is supported by insurance companies, and it collects medical information about an applicant's health as reported by insurance companies after underwriting. So I think we got 3 wrong, which is not going to get us to pass, but that's good because we'll go over this one again on Tuesday, and then we'll go into chapter 9. So grade the exam. I think we're going to get, what is it, a 73? Yep. So there it is. Any questions? Comments, thoughts? Let me see just quickly if Tavana is on. Curious.
Recording in progress.
1,000 early stage VC crypto VCs out there.
So she's not yet, but any other questions? I can show you guys something really quickly. Let me just show you this really quick. Actually, I don't even need to go do that. Okay, so Circle Financial, marketing, IULs. Okay, so I want to just show you guys something really quickly, the power of what we do. Death benefit A. Well, this is still a good example. So this is if somebody were to take a policy out for their daughter, 6-year-old, 10-year-old, $100 a month, $100 monthly. And this is just a quick illustration of of how somebody could create generational wealth. Let's just assume for this purpose that they just continue to pay this, they continue to pay this. The child ends up, when they become an adult, they take it over and they just continue to pay it, and they go all the way, and let's just say that they die at age 90. They would have put in
And this
90.
is whole life?
This is index universal life.
Okay.
So this is a universal life policy. So the difference between the two is whole life gives you a guaranteed interest, but it's usually low. So usually in the neighborhood of maybe call it 3 or 4%. This, on the other hand, in the past, let me show you an example of what this one has done. This one, they're showing 7.28% if you choose the S&P 500. And the one we normally choose is Barclays. And that one, we're able to show 7.6. So you can see it's almost double what whole life is if it does based on the current assumptions. So in actuality, the S&P 500 over the average 25-year average is 9.26%. Or then, I'm sorry, the maximum 25-year average is 9.26%. The minimum 25-year average is 4.62%. So you see that even in the minimum, if you were to use the S&P, it's more than what your average whole life policy is going to be. So this is a strat. And then the other, so you have the potential to get more upside. So that's the quick difference between a whole life policy and an index universal life policy. It's not guaranteed, but the potential is higher that you'll get more. And then what I always say is if it gets to the point where this thing just, like if the market bottoms out. So let me quickly just say with index policies, if the index goes up, you gain money and your cash value increases. But if the index goes down, your money stays the same. So if you continue to get this upside, you get a good year and you get 15% some years, and then the next year the market tanks and goes down 20%, you're going to keep that 15% gain and your money's not going to go down.
But it wasn't earned during that particular time.
It would earn 0.25%. So it would earn almost, call it zero, but it wouldn't earn, but you wouldn't lose money. So if you had money in the stock market and the market went down 20% or 50% or Great Depression, 80%, then your money would stay the same. Your money, you wouldn't lose money. So anyway, so to show you age 90, this child put in 96,000. The next generation will get $3.4 million. Now imagine if every Black family did this with just one of their kids. Just one of their kids. This is the difference that we can make in our community. 3.4, call it $3.5 million. And so in full disclosure, this is based on current assumptions or based on the maximum that we're able to show. This is based on 4.5%. So at age 90, you would have put in 96, and they would be $680,000 of life insurance. Now, all these zeros are scary. What does that mean? That means that if every single year for 80 years, the stock market goes down and all you get is the guaranteed 0.25%, which you get when the stock market goes down, then it's going to be at zero. But let me tell you something. If the stock market goes down every year for 80 years, we're freaking, we're living in tents, or I mean, the whole system that we are aware of has collapsed. So this means that the world as we know it has changed. This guaranteed assumption, 0.25%, that means that not a single year did the stock market go up. Not a single one. So the likelihood of that is very low. Very, very low. So this is an index universal life policy. Rashad, this is the one that I'm going to submit for you. And Daoud, this is the one that I'll also show you an example of what you can do at some point when you're ready. So any questions on this? And, also let me show you. So let's say at age 40, they now want to go and buy a house or get married or who knows what they want to do. They would have put in 36,000 total. This cash value here, they would have $86,000 that they get access income tax free. When you compare that to a taxable money, that would be somewhere in the neighborhood of $110,000 income tax free. And then the money continues to compound. And this whole time they have life insurance. And this whole time they have living benefits. So they get accelerated benefit for critical illness. If they're terminally ill, they have a rider. And then chronic illness is equivalent to nursing home care or long-term care. So if you were to get a long-term care policy, they are very, very, very expensive. This chronic illness rider comes free with all of the policies that we sell. So it's a way to get added coverage. Most people, I'm not sure if this is 100% true, but many people who go into bankruptcy do it because of medical expenses that happen. A lot of times, you know, just think of it this way. In some states, long-term care coverage is typically going to be somewhere between $5,000 and $10,000 a month. So if someone, say, has $100,000 saved in the bank and that's what they want to pass on to their family, or that's what they're living off of, they're going to be forced to pay down all of that money before they then get put on Medicaid, at which point they take whatever the state gives them. So this gives them additional coverage inside of these policies. You know, frankly, I mean, I own one of these policies. It's something that everybody should have. So on top of it, if this policy is kept, $96,000 turns into $3.4 million. Any questions on this? No questions?
No, I don't have any questions. I followed you.
Okay, so we're going to end tonight now. I'm not going to be doing